the gateway to tokenize and financialize trillions of real-world assets has opened.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money. This is the show that goes beyond the headlines to uncover the truth about the precious metals industry. And joining us today is none other than Kinesis' very own world-renowned whistleblower and precious metals industry expert, Mr. Andrew Maguire. And this week, we'll be answering more questions from the Live from the Vault community. So keep those questions coming in. All you got to do is look below in the link, click that link there, record your question, and you never know, your question may be asked for Andrew Maguire to answer right here live on Live from the Vault. So this week, again, our question is from Jeremy. So let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, this week we have a question, a great question by Jeremy. Let's go ahead and roll that question, and then over to you, Andrew.
Hey, nice to be with you, Shane. Yeah, look forward to it. Thanks, my friend.
Hey, Andrew. Apart from Trump's tariff talk, I haven't really seen much about what really happened at the BRICS summit in Rio. You mentioned gold, silver, and other BRICS commodities are starting to trade more freely in their own markets instead of being stuck under the LBMA price control. Does that mean prices could jump? What are you seeing?
Oh, Jeremy, great question. As according to as we would believe, the Western spin, I mean, it's as if the BRICS summit never happened. Yet, under the covers, the gateway to tokenize and financialize trillions of real-world assets has opened. Let's dig into the question, because this ultimately leads to a consensus of liquidity providers pricing gold at a fair value at $8,000. We discussed it last time. And as we recently indicated, silver well into the 3 digits. Now, while this gateway opens up every single commodity to be traded and settled intra-BRICS national currencies, we've been focusing on the West's underestimation of the BRICS nations' ability to actually take full control of the gold-silver price-setting mechanisms, and how, through the formalizing of the financial infrastructure to support a sufficiently liquid global settlement process, the CME, LBMA will increasingly become price takers, not price makers. And this is happening under our noses. And we will see, as we'll see, this is actually central bank driven. And so, responding to Trump's warning to the BRICS so-called war on the dollar, let's start by looking at what Russian Foreign Affairs Minister Sergei Ravkov reiterated yesterday. And basically he said, no one in the BRICS community is raising the issue of replacing the dollar. The alternative is to switch to settlements in national currencies. That's the path we're taking with BRICS. So really, you've got two different views here. Now, what's being missed by the dollar hegemons? It's not an attack on the dollar. It just means that intra-BRICS trades will be cleared outside of the dollar. Now, Western-facing commodity traders will continue. These trades will continue to be settled in dollars because they face the West. But, and a very, very big but, the price will be influenced by the BRICS nations' physically determined supply-demand prices. And this will be most evident in the real supply-demand pricing of commodities that are also crossed against global-facing foreign exchange markets, of which gold, silver, platinum, and palladium are crossed against. Obviously, not all commodities. In fact, no commodities other than gold, silver, platinum, and palladium are actually crossed seen as money, as a foreign exchange cross against the dollar and the euro, yen, etc., etc. Now, the BRICS multipolar global price discovery process is not just contained to the foreign exchange crosses in gold, silver, platinum, and palladium. In aggregate, including oil, energy, and rare earths, the BRICS nations are estimated to produce, consume, and ultimately control some 85% of an 8 trillion a year global commodities complex. Now, along with precious metals, as we are going to see, BRICS nations are going to become the price makers, not just in the precious metals complex, but also in every single commodity they touch, utilizing the trustless blockchain rails, the tokenization, financialization, and a 7-second settlement process will ultimately dictate a truly multipolar price. Clearly, this is going to backwash into the leveraged, asymmetrically imbalanced derivative markets, which gear around all of these products. Now, what we're going to expand on from our last episode is how, beginning with gold, silver, and all monetary assets, every single real-world asset is in the process of being tokenized and financialized to trade and be settled outside the weaponized dollar-based system. And as we drew attention to during the BRICS summit, backed by central banks, sovereign, and fresh safe haven physical demand, we have Singapore, Shanghai, Hong Kong, Saudi, Brazil, Africa, Southeast Asia. They've already aggregated sufficient physical market liquidity to actually benchmark a global physically determined supply-demand gold price. Now, following the BRICS Rio summit and Trump doubling down on tariff threats, the gloves have now come off. Now, in keeping with the overall BRICS mandate of taking barriers down, really to empower multipolarity, the focus on the Rio BRICS summit was on providing, this is the key thing, the necessary financial multipolarity to be able to price and sanction-proof commodities into a blend of BRICS local currencies. Now, completely missed by the mainstream media and the Western observers is that the complex task of benchmarking trillions of non-dollar denominated intra-BRICS trade will be benchmarked by pegging this blend of widely varying national currencies to a prescribed weight of gold. Now, as we've looked at last time, this de-dollarizing effort is actually being facilitated with the expansion of the new development bank, the NDB, bolstering inter-BRICS national currency trades, ultimately benchmarked to gold, a percentage of gold. Now, Russian Finance Minister Anton Siluanov confirmed that the NDB had formalized a multi-billion-dollar sanctioned tariff-proof cross-border settlement hub backed up by loan guarantees for mega infrastructure projects across the BRICS sphere. Now, we put up some links on these initiatives last time, but in short, with over 80% of the world's population gaining economic weight and already controlling 40% of all global trades, Trump's tariffs are nothing short of war measures into which the BRICS nations are countering to rapidly consolidate resources. Now, the NDB are consolidating with supporting Chinese initiatives as well. And this is not just a soulless operation. This is really well put together. And so they understand that the provision of the necessary financing is required to bring this forward. And there are a lot of instruments under this initiative, but gold as money will benchmark all local currencies. Now, while everyday current BRICS pay transactions are currently not directly backed by a weight of gold, because they are settled within the BRICS clear system, the FX value of each nation's currency is actually being weighted against each other by the percentage of gold backing up that individual currency. Hence, the race by every BRICS central bank to accrue as much gold as possible. And much of these gold purchases escape reporting. And while we've been tracking direct central bank purchases for a heck of a long time, some of these transactions have been acknowledged by the World Gold Council in this report. So in essence, 19 out of 36 respondents in the World Gold Council survey said they're buying gold directly from domestic artisanal and small-scale gold miners in local currencies. Okay, so you need a facility for that. 4 are thinking of following suit as well. Now, this is a slightly higher figure than last year's survey, which was there was about 14 central banks out of 57 said they were buying directly from domestic sources. What does this do? It leaves the LBMA cartel of market makers out in the cold. Furthermore, as we've been tracking ever since the IMF refused China's offer to buy its share of the 400 tons of IMF gold. Remember, that was back in 2010. And you remember that they put up 400 tons of gold for sale. India was allowed to take half, 200 tons. But Beijing's bid to take the remaining 200 tons at the current price was then about $1,000 was absolutely blatantly refused. So China went on the offensive against the West. That was really the pivotal moment where China moved in against the West. And as we tracked at the time, that remaining 200 tons was sold into the market as part of the 50-year gold capping mandate. In other words, we saw time and time again over the years, gold being sold into the marketplace or leased into the marketplace. So this was a way of continuing that game. Now, it's no coincidence, though, that this was when China pushed back at the West by opening its gold market to its citizens. Do you remember there was billboards the size of houses put up, TV adverts, go buy gold? Now, it astounded a lot of people because no one had ever seen a government do that before. So now, around $2,500 higher, this process has continued in layers, and at over 31,000 tons, Chinese citizens own by far the largest private holdings of any country on record, even more than officially held Indian citizens' declared holdings. Now, obviously, the Reserve Bank of India does not know the true extent of the thousands of years and thousands of tons of dowries and gift accumulations. But needless to say, even accepting the declared holdings, just these 2 BRICS members alone have around 10 times as much treasure as US Treasury stocks contain. So, it's important to kind of put this into perspective. So ultimately, with gold increasingly backing real-world assets, the US administration has 2 choices. Head into a losing head-on battle against the global majority, or revalue gold to compete. Well, it's pretty clear they're going to have to take the latter option. China stepped up the gold buying ante in February. If you remember, in February, they mandated Chinese insurance companies to divest billions of US treasuries and dollars into backing 1% of their 43 billion of pension assets into gold, a process that has only just really begun and on its own would have been sufficient to drive the gold price above 4,500 by the fourth quarter. But we've got reliable information that this percentage increased to 2% in June, which equates to over 25% of all global mine supply. And word is this is ultimately going to rise to 10% or 4.3 billion in 2026. Now, it's no coincidence that the very large unreported 400-ounce monetary central bank purchases have consistently flowed out of London, out of Switzerland and Dubai hubs over the last 15 years, enabling tens of thousands of tons of gold to be secretly accumulated. And as we've discussed last time, a very large percentage of Beijing's gold reserves what they do is bolster military assets. And as such, real gold assets are as closely guarded a secret as weapon systems and strategies. So this odd 2,900 tons they talk about is window dressing. This is why official reserves do not include unreported BRICS, primarily Russian, Chinese, and Saudi, 400-ounce monetary gold accumulations, which also picked up significantly in March 2022. Not including what is secretly held by the Chinese generals, empirical evidence suggests that in aggregate, including this 2,292 tons of officially reported gold, Beijing has salted at least 35,000 tons of gold inside the state-held banks. And this is why we drew attention to the probability that into the very real threat of a US-China South Seas China-Taiwan war, should Beijing need to actually bolster their gold reserves, as we saw in the trial ballooned 2023, we covered this in an episode back then, where they trial ballooned Chinese citizens' gold could be, as we say, patriotically leased into the state as part of the war effort, with the PBOC assurances it would be equitably returned at a higher price. And as such, in time of war, Chinese physical reserves could easily exceed over 70,000 tons. So I'm just trying to give an idea of the scale here. As these gold assets, as they're tokenized and provide real money backing to real world assets to be traded in real time into tariff sanction proofed 7-second settlement process, the process of wresting control of the gold, silver, platinum, and palladium FX markets from the LBMA cartel is already underway, enabling the BRICS nations to take control of the lion's share of all the commodities they control. And while this de-dollarizing process has been progressed by stealth, Trump's tariff sanction threats equals a declaration of war and has significantly accelerated the process. Now, one only has to look at the charts, really, of the two LBMA CME market makers acting for the Fed. They still enjoy sufficient COMEX position concentration, which is the key. Is that's how they can act as a cartel, because they have the massive position that can be when you have a position concentration in any market, then obviously you can move stuff around. And they can collusively set up regular end-of-month wash and rinse cycles. And we saw another attempt today. But these synthetic efforts are notably muted. And quite simply, there's insufficient leveraged Western speculators left to be sucked into the COMEX meat grinder to maintain this 50-year synthetic gold price suppression machine. Underpriced, unallocated COMEX gold is being targeted by increasingly liquid BRICS-centric physical exchanges. Now, because the BRICS gold price benchmarks a true physically settled, and this is the key, globally fungible, Basel III compliant, first-tier, high-quality liquid asset price, gold anywhere around the world is physical gold anywhere around the world is immediately fungible across the globe at the price, the global price. So that's going to impact this settlement occurring outside the LBMA is going to really backwash into the local London gold fixes, which also have to be Basel III compliant at the moment of the fix. Now, BRICS determined physically settled prices are increasingly washing back into these diluted local London price fixes, sucking in underpriced COMEX exchange for physicals. You remember, we've got that backdoor at the COMEX where there is the ability to take a COMEX price and shove it into London, and then it becomes T+1 deliverable. There are big shortfalls occurring, and we're seeing some big exchange for physical spreads to short cover.
Hey, Andrew, first of all, thanks a lot for answering Jeremy's question in such detail. And, as usual, we have a lot of other questions here on Live from the Vault from the community on what you're expecting in the shorter term. Can you take a look at the shorter term for us here?
Yeah, Shane, it's quite revealing. Let's take a quick look at the charts, as it makes it much easier to explain. Just for reference, I'm recording this after the PM fix on Wednesday. But let's just step through. Look no further than last week's efforts, really, to synthetically sell the Asian-facing, physically determined AM fix into each day's synthetically diluted PM fix. So AM fix, PM fix, AM fix, PM fix, AM fix, PM fix, AM fix, PM fix. It was getting tiresome. Then on Friday, that broke. Then on Monday, it actually backfired. And it also backfired again yesterday. Now, it looked pretty good today, but then, of course, now we've got the EU deal being telegraphed as a tariff deal being announced. So we have the usual wait until it's fully cleared to pull the bids and create some downdraft. This is all short-term stuff because into each day's synthetically diluted sell-off, their central banks are underpinning the next in a series of higher stair steps, which is already in place. And really, so basically what they've been trying to do is walk gold below the 50-day moving average, which is rising, basically because you're going to see a lot of momentums go short there. So essentially, that's all that's going on. And here we are creating another higher stair step, probably here, but already in place. We had this already in place in our last episode. Now, obviously, we're headed into another end-of-month mark-to-market derivative event, which is really what this is all about. And there are so many physical buyers who are literally going to sit and stealthily wait to take what's on offer into the end of the month. So after a little bit of healthy consolidation, i.e. kicking out some of the specs that jumped on board, what we're seeing is this is only going to serve to underpin the already established, but also the next higher physically determined stair step, after which we're looking for gold to commence the next leg of a large short squeeze. Weighed up against the bigger picture, following the PBOC's strategic launch of the Shanghai Futures Exchange on the 1st of March 2024, the process of draining unallocated Western gold into BRICS nations' vaults has significantly stepped up. So short-term official attempts to cap gold against the dollar by way of monthly wash and rinse cycles, and this is a monthly chart. So we see here. What it reveals is 16 months of Fed-borrowed Bank of International Settlements gold leases being bought back at higher and higher and higher and higher prices. And we've only had 1 month, and that was in December, where actually they managed to buy it back lower. And that was after a massive attempt to rinse out speculators, which was immediately bought by China. So we just move forward to where we are now. And one by one, these settlements have been higher and higher and higher. And even last month, despite every effort, they failed to get it any lower. What this is illustrating is the slow demise of the LBMA CME's price capping influence. The resulting impossible to ignore series of higher physically supported stair steps provides clear evidence that sufficient CME LBMA paper market liquidity has been alchemized, meaning turned into physical gold by physically settled exchanges, which are now taking control away from the LBMA CME ringmasters so as to benchmark a real globally determined supply-demand price, namely the price the owner of a physical bar is actually willing to accept an offer for it. In gold, with very few offers to even lend metal now, lease costs have also expanded. Short-term lease rates for gold are currently 9.4%, indicating tight supply. Now, this is a silver chart. I'm going to actually ask you to remember this spike higher where silver finally broke out of the LBMA's control and the 92-cent premiums being charged for the shorts to actually cover. And essentially, that proves that these asymmetrically imbalanced trades, this is commercials having to buy back their short trades well in excess of $4,000 per contract, higher than they wanted to. So just keep that in mind for when we look at silver. So in summary, the LBMA are losing control of this counterintuitively based 50-year price suppression game, which has allowed them to cash settle gold alongside every other fiat diluted asset. And they're losing this control because in aggregate, the BRICS nations have now accrued sufficient physical market liquidity to actually benchmark this self-arbitraging, fungible global sanction and tariff-proof gold price for T+0 settlement. We're talking instantaneous settlement. So in sync with the NDB rollout, China's cross-border payment system, the CIPS, already interconnects with 4,900 banking institutions, and it's growing by several every day. Now, the CIPS settlement platform actually overtook SWIFT transactions in April. I thought it was May, but it was April. So tokenizing these BRICS collaborations into stable coins backed by real assets, along with a race to secure as much gold as possible to back the value of each nation's foreign exchange currency, provides BRICS nations and their counterparties with a very liquid 7-second settlement process. Now, following Trump's 50-day Russian and BRICS counterparty tariff sanction threats that followed 2 weeks, I think it was last week or the week before, when we saw freshly weaponized EU-Russia sanctions, what we have is credible information. The already beta-tested 40% gold-backed decentralized sanction and tariff-proofed blockchain rails are about to formally launch. The clues are actually all there. Following China opening up and opening vaulting and physical metal facilities into a series of Western-facing gold vaults and settlement hubs where it can be moved across the floor and delivered T+0. There's a lot more of these beginning to follow. Now, these are already the same hubs that we referred to earlier. We've got Singapore, Shanghai, Hong Kong, Saudi, Russia, Brazil, Africa, Southeast Asia, and there's more to come. These are all vaulting hubs, Shanghai facing vaulting, international facing vaulting hubs where gold can be priced centrally in the BRICS areas and can then be delivered T+0, as I say, by literally moving it. And it's fungible. So therefore, if a transaction happens in Singapore and it's happening in Brazil, because it's fungible, then literally you just move it across the floor here and you move it across the floor here. So it's so simple. It's unbelievable. As part of the initiative to price gold outside of local London, Russia is launching gold trading on the St. Petersburg exchange, which is the SPOMEX. And more initiatives to benchmark gold and silver within the BRICS sphere are rolling out monthly. Going to see a hell of a lot more. So really, to sum up, we're witnessing the demise of the Western-run paper-driven gold suppression game, which is why every single bullion bank, every central bank, sovereign and institutional buyers are swapping their depreciating, debasing fiat currencies to load up on physical gold and silver at prices they perceive to be hundreds of dollars below where the as yet undefined supply-demand price ultimately is going to settle.
Hey, Andrew, our silver stackers are going to love this. Now, you predicted silver had already broken its LBMA leash, and you viewed silver at 36 a stacker's bargain. And you were suggesting that there was very little real resistance between then and $40 an ounce. Can you update us on what you're seeing right now on silver?
Yeah, Shane, and that's just really the short-term stuff. Look, with COMEX silver market, COMEX silver market, the paper-settled liquidity element, along with producer financing initiatives leaching over into the Chinese physical exchanges, silver has now largely escaped the LBMA stranglehold. These same actors are having difficulty in containing silver, as is now evidenced by the very large exchange for physical premiums to short cover, levels we actually haven't seen since the COVID shortages. The LBMA has lost the paper to physical battle and are racing to short cover. Okay, you're going to see some intraday moves, but this is short-term stuff. And while spot silver is not Basel III compliant, it is a deliverable foreign exchange money cross against the dollar, etc. And as with silver supply getting priced outside of the LBMA's control, the Loco London Global Silver FX fix is that benchmarks the global physical supply demand settlement price. It's going to have to rise to meet this balance, or it's just going to be drained, which is exactly what we're seeing now. The silver fix benchmarks a direct producer to end user price. So any discrepancies will be arbitraged. Liquidity providers report continued accumulation of underpriced LBMA CME silver is stepping up. So to put the BRICS-driven silver LBMA short squeeze into perspective, we really noted two things. The current front contract silver contract, the contract versus weighed up against the spot price, the physical spot price. That EFP, that exchange for physical, that connection, in other words, the ability to short cover, has significantly expanded into price rises, and then it rapidly contracts into bid-pulled dips. So what's this telling us? It's because we initially evidenced a 92-cent COMEX premium. That's, ouch, $4,600 per contract. You had to pay that premium to be able to cover shorts into the 11th of July BRICS-driven breakout. However, as I record this, the cost to short cover asymmetrically imbalanced shorts is still elevated at around 40 cents or $2,000 per contract. I mean, evidencing this paper to physical imbalance is still unresolved. So short-term silver lease rates are also at 6.5%, also attesting to this tight supply. And looking at the options structure, which is obviously we always look at what's going on at the end of each month. And Monday is options expiry. And of course, these option structures are, after given the price rises, and they were put in place a long time ago, between 6 and 12 months ago, they're offside. Now, silver is not, this contract is not in delivery, but footprints are evidencing that this asymmetric imbalance short skewed EFP price, because it's commanding such very large premiums, we're seeing dips being used as opportunities to short cover. And this should keep dip shallow and continue to drive very large short squeeze into the 50s, where we expect very large sideline BRICS demand to pick up. Best estimate is $80 before equilibrium is found. So look, thank you so much for your questions. The only one I have for you is how much physical gold and silver do you have now? And how much of your depreciating fiat dollars, pounds, euros, yens, Swiss francs, etc., are you investing into grossly underpriced physical gold and silver?
All right, that wraps up another episode of Live from the Vault, brought to you by Kinesis Money. And a big thank you to Andrew Maguire for sharing his deep market knowledge. And thank you for tuning in and being a part of this growing global community right here at Live from the Vault. Now, if you're new here, make sure you subscribe, hit that bell right there so you'll be the first to know as soon as this episode and as soon as these episodes go live. And if you've been with us for a while here, keep helping us spread the word by giving us a like, not now, but right now. Hit that like button and share this episode with someone who really needs to hear this information. Get your questions into Andrew Maguire, and you never know, your question may be selected for next week's episode right here on Live from the Vault. So with that, we'll be back next week with you, and we'll have more truth that you just won't find on the mainstream media. And until then, remember, buy physical, make sure it's backed 1-to-1, and we'll see you next week right here on Live from the Vault. Bye for now.